Very warm greetings to one and all watching this video lecture. Myself, NishiPathak, Assistant Professor, associated with Department of Management Studies at Rajkumar Goyal Institute of Technology, Ghaziabad. Today, I am here to take a lecture on mutual fund industry. We have been hearing about this term again and again. A very common term that has become a part and parcel of our lives as and when the interest in the investment is increasing. With the increase in the purchasing power of the people, with increase in the savings of the people, this is a common avenue that the people are ready to invest in because it helps in diversification of risk. Right. So, let us begin with our lecture on mutual funds. Now, when I talk about mutual funds, it is an organization that collects the small savings of various small investors, collects it into a pool and then invest in a number of securities. Whatever profit is earned on this mutual fund option, it is distributed among the unit holders. These unit holders are the small investors from whom the savings were collected in order to pool them up. So, that is a mutual fund. Now, the mutual fund is based on the concept, it is based on trusteeship. Trusteeship is when you are working for a person, you are working on behalf of a person in order to give maximum benefits to the interested party, right, to give the maximum gains to the interested party, right. So, mutual fund works on the funda of trusteeship. It is the trust that is shown by small investors on the portfolio managers, and this trust pays them off in the form of what? The return from the market that they gain. We have various benefits of mutual funds. It is expert knowledge, it is diversification, it is a low cost of investment. Why low cost? Because we are investing only a small amount into it. We do not need to have a very lump sum amount in order to invest and gain more and more. And it helps in risk sharing also. It helps in risk sharing also. Why? Because here we have a number of investors who are making investment into a certain mutual fund that diversifies the risk. Now, why this mutual fund has gained momentum is the deficiencies that were there in the capital market. When we are talking about investors, it is not possible for them to create their own portfolios, to create their own investment options and then manage them also. Just because they do not have the knowledge, proper knowledge or complete knowledge, and at the same time expertise based on experience in this particular field. So, that is why mutual funds are gaining momentum in the market. I already told what is done in this. We are collecting the savings from small investors, we are pooling them up, and after the pooling we are investing them into as such avenues that would give us benefits in the form of returns. So, that was mutual fund. When we try to focus on the history of the mutual fund came into being in India obviously in 1963. That was the era when the mutual fund started in India. UTI, the Unit Trust of India, was having a dominating part when we are concerned with the mutual fund, with almost a turnover of 700 billion and more than 20 million investors. Right. A very famous scheme that was launched by UTI was Unit Scheme 1964. That became to be the biggest scheme that was launched and was popularly known as US 64. Right, it existed till 2008 and it was dissolved in 2008. So that was the beginning era of mutual funds. Then in 1990 came the time when the public sector banks were given the entry in the mutual funds, and it became the second largest market in the mutual fund. Then in 1993 the private entries in the mutual fund were allowed, which resulted in the third largest mutual fund industry, right. And then in 1996 it marked the era in which SEBI became the regulatory body regulating all the activities of it was regulating the activities of stock market also, and it was started regulating the activities of the mutual fund also. And then we had the AMFI that came in. AMFI means the Association of Mutual Fund in India. So this was the historical perspective of mutual funds, and since then it has not looked back. It is gaining market, it is increasing again more and more into the investment options. Now, what are the major constituents of mutual funds? We have four major constituents of mutual funds. We have the sponsor, we have the mutual fund organization, that is known as a trust, we have the asset management company, popularly known as AMC, and we have the custodian. What is a sponsor? Sponsor is sponsor basically is the institution that would introduce the mutual fund, that would bring the mutual fund into existence. Now this sponsor could be banks, it could be private and public limited companies, it could be any of the financial institutions. There are certain norms that have to be fulfilled that are set by SEBI, and then you can become a sponsor, giving the range of bank, financial institution, or public or private limited companies. A requirement that has to be completed by the sponsor is that it needs to have a track record of successful profit earning at least for 5 years and with a positive net worth. It makes you eligible to become a sponsor. Then we have the mutual fund organization or the trust. The mutual funds in India, most of the mutual funds are based on trust. They are working in the form of trust. This trust is formulated by the sponsor. Then we have the asset management company. The asset management company is the a group of professionals. It is the group of experts who are collecting the savings of the people, mobilizing them, pooling them up, and then mobilizing them into the channels that would give maximum returns. Then we have the custodian. Custodian is what? Custodian is where the securities are kept in a safe mode. Our securities are stored in custodian, whatever are being a part of the mutual fund. The dividend collection or any of the collection, benefit collection on behalf of the mutual fund is done by custodian. The post trading activities is another function of the custodian, right. Keeping our securities in a safe mode, in a safe way, is the function of custodian. So these are the four basic constituents that make the working of the mutual fund mutual funds a smooth functioning. Now all these four mutual fund constituents need to be set according to the guidelines that have been set by SEBI, and they are regulated by SEBI itself. Then we have the regulation of mutual funds in India. Now, when I am talking about the regulation of mutual funds in India, we have a number of formalities that have to be done number of rules that have to be followed, and all these guidelines, all the rules and regulations are set by SEBI and monitored by SEBI itself. Now, the first and the foremost one is formation and registration. Formation and registration means, as we discussed in the previous slide about the constituents of the mutual funds, it is compulsory for all the constituents of the mutual fund to be registered with SEBI. There are certain guidelines, there are certain rules, regulations, there are certain qualifications to be fulfilled in order to bring out the schemes under mutual funds that have to be fulfilled, right. Registrations is to be done, requisite fees is to be paid, all this is done under the guidelines of SEBI. Then we have documents of scheme. Once we are prepared in order to bring the mutual fund into existence, we are ready to float the mutual fund into the market. What we have to do is we need to issue an offer document. Offer document has to be issued. Now, it is necessary for the mutual fund, for the sponsors, for various constituents of the mutual fund to get this offer document vetted by SEBI. By vetting by SEBI over here, I mean that the SEBI is going to check out whether the norms of full disclosure and transparencies have been fulfilled or not. All the minute details related to the mutual fund, related to the schemes that are being launched, have to be mentioned on this offer document. All those information that can affect the decision of the investors, that can affect the performance, has to be mentioned in this offer document. Then we have the regulation of schemes. By the regulation of schemes, we mean that SEBI regulates the schemes launch, right. At the time when the schemes are being launched, the SEBI is going to regulate these launches. For the open-ended schemes, we have open-ended schemes, we have close-ended schemes. So, when we have the open-ended schemes, the minimum of the corpus has to be rupees 50 crores, right, and for close-ended it is rupees 20 crores of the corpus. Rupees 50 crores of the corpus, rupees 20 crores of the corpus, we mean that it is counted as the amount that is collected within 45 days of the issue of the scheme. Then we have investment by the mutual fund. Now, when mutual fund has been launched, it is the investment part has to be done. Now, it is not that I can take my own decisions, right. There are certain norms that have been set up, and according to them, according to those rules only, the mutual fund houses, the AMCs, can do what? They can invest, right. Like, they cannot invest more than 15% in the money market instruments, or they cannot invest more than 25% in the unlisted securities, or they cannot invest more than 15% in the debentures of a particular company, right, and so on and so on. So, every investment that the mutual fund is going to make has a certain limits that have to be followed. Then we have the advertisement of code of conduct. Advertisement is to be done according to the SEBI guidelines, whatever the guidelines have been set up by SEBI. All the information has to be disclosed, all has to be intimated in the advertisement, along with the risk associated if a person is investing in the mutual fund, in the scheme that is being launched. Then disclosure of the NAV, the net asset value has to be disclosed in accordance with SEBI. According to the guidelines of SEBI, the NAV can be calculated as market value of the investment in the that is there in the scheme, plus the net receivables, plus the cash upon the number of units right, the number of units that are there under the scheme. The next point that we would be discussing is the disclosure of the NAV. Now, this disclosure of NAV, that is the net asset value, is to be done. It has to be disclosed time to time, and that is the guidelines given by SEBI also. It has to be disclosed in accordance with SEBI. We can calculate the net asset value with the formula using market value of the investment that is being done in the scheme, plus the receivables, the net receivables, plus cash divided by the number of units under the scheme. This is how we can calculate a NAV. And the last point is related to the winding up of the mutual fund. Winding up of the new mutual fund means the coming of the end of the mutual fund. That would have different norms for open-ended funds and close-ended funds. Now, when we are talking about open-ended funds, let us talk about the close-ended funds first. Close-ended funds would be the ones that have a particular maturity date. Obviously, normally it is 3 to 15 years, right. So, they would obviously wound up after the stipulated time period that has been prescribed, until and unless they have taken the permission for rollover either from SEBI or from any of the concerned authority. When we talk about the open-ended funds, in open-ended funds the subscription is open for the whole year. So, technically or in normally there would be no winding up situation in the case of open-ended funds, right. But then too, if the performance of such mutual funds goes down, the corpus of these mutual funds goes below the 50% of the original corpus, in that case the mutual funds in the case of open-ended funds can also be wound up. So, that was the winding up. These are the regulations that are there, that exist in India for the mutual funds. Now, we have the next topic as types of mutual funds. Now, first two slides, this slide and the next slide provides you the various types of mutual funds that can exist. The mutual funds that are existing basically are they are named basically on the basis of the functions they have, on the basis of the features that they have, right. And then after this we are going to discuss the classification based types of mutual fund. So, open-ended funds, close-ended funds we have been talking about. Open-ended funds are the funds that are open for the whole year. They normally do not have any maturity date. The people can invest in any time, right. Close-ended funds normally have the stipulated maturity period that ranges from 3 years to 15 years, right. Growth funds are the funds that invest in equities, where the investors require capital appreciation. They are more investing in equities. Then we have equity funds. Equity funds would be the ones that are investing in the equity shares. Then we have the balanced funds. Balanced funds would be the combination of equity and debentures. Money market mutual funds, that would be investing in money market instruments like the certificate of deposits, commercial papers, treasury bills and so on. Then we have equity linked saving schemes. These are basically those investment options that provide tax saving to the people who invest into it. Then we have infrastructure funds that would be related to the infrastructure portion. Then we have debt funds that would be investing in the debt of the companies in the form of debentures, bonds. We have income and growth funds combined over here that would focus on debentures and equity at the same time. Then we have income funds that would focus more on giving a regular income to the people. Power mutual funds related to the power sector. Then we have the index funds. Those index funds would be following certain index, financial index, like it could be the Sensex, it could be Nifty 50, or it could be the Standards and Poor 500, S&P Poor. Then it could be IT funds that would focus on the investment part in IT sector. Then we have funds of funds. Now, in funds of funds, we are not investing in directly into securities, but what we are doing is we are investing in the existing investment options, investment schemes, existing mutual funds that are already existing. Then we have dynamic funds. Dynamic fund is the opposite of balanced funds. Balanced funds maybe try to balance the investment between the debentures, between the equities. Dynamic funds is a combination of debt and equity again, but there could be a massive proportion that can take place. Like it could be a condition in which we could invest 100% into equity, or we could invest 100% into debentures also. So, that is a dynamic fund which contains the combination of equity and debentures, but the massive proportion is the important feature over here. Now, we have the classification of mutual funds. Basically, whatever we have been discussing in the previous slides is somewhat the part of classification of mutual funds also, right. So, we have different classes that have been mentioned over here. The first and the foremost one is based on structure. Based on structure, we have open-ended funds, we have close-ended funds, we have interval funds. Open-ended funds, as I have previously spoken on, is the funds in which the subscription is open for the whole year. The interested investors can go and subscribe at any time of the year. The NAV has to be disclosed from time to time, right. Then we have the close-ended funds. Close-ended funds means there is a maturity that is associated with such funds. They would have a stipulated maturity that would be there. It could range from 3 years, it could range up to 15 years, and that means they are going to mature at a particular point of time that has been previously specified, until and unless they get the permission of rollover from SEBI, or it can be from any of the concerned authority that would give permission. Then we have the interval funds. What are interval funds now? Interval funds are also known as hybrid funds. Now, this interval funds basically has the combination of both the open-ended funds and close-ended funds. They would have, that is why it is known as hybrid. It would have a particular subscription time also, and at certain time periods after the subscription period goes closed, it would be opened in future once again, right. Those would be the interval funds. Then other classifications that we have is the tax saving schemes. Many of the investors invest in mutual funds, or they make their investments in order to get tax saving schemes, in order to reduce their tax that they are paying in the form of income tax. So, ELSS schemes, pension schemes are certain options that provide tax benefits to the interested investors whose intention of investment is tax saving. Then we could have industry specific. Industry specific, as the name suggests, is a fund, is a type of mutual fund that focuses on a specific industry. It would focus on a certain industry, it would try to include securities, it would try to include investment options in the mutual fund of a particular industry, focus on a particular industry. Then another classification in this category is index funds. Index funds are those funds that basically focus or try to copy or try to imitate the index that are existing in the financial market. It could be For example, it could be Nifty 50, it could be the Sensex, it could be the Standard and Poor 500, right. They try to copy the performance of these particular financial indexes. Then the next category of mutual funds is the objectives of the investment. The basis over here is investment objectives. On these bases, we have different types of funds that exist. We have the growth funds that try to provide us with the capital appreciation. The investment in such funds is more and more done in equity shares, right, and these growth funds would be the funds in which the investors who are ready to take risk would be interested. The people, the investors who need more capital gains, who want to make capital appreciations, they would be interested in growth funds. Then we talk about the income funds. Income funds would be the funds that would focus on a regular income to be provided to the investors. In this, we try to invest in fixed income securities that would give a fixed return to us. Then we have the balanced funds. Balanced funds are the combination of growth and income funds. We are going to invest in the both options. We would be these funds provide capital appreciation along with an income. So, here we are focusing on both the growth and the income, regular income also. Then we have the money market funds. Money market funds are those funds that focus on investment in the money market instruments like the treasury bills, right, like the certificate of deposit, the commercial papers and so on. Then we have the load funds and no load funds. Load funds are those funds that have the entry and exit fees that is executed on them, which is normally 1 to 2%. Now, it is beneficial or it is worth giving this load funds if we can earn a high return from any of the schemes being launched. We have no load funds also. These no load funds are those funds that do not have any entry or exit fees with them, attached with them. That means the entry and exit from such funds is cost free. It is not going to bear any cost on the investors. So, these were the various categories of the mutual funds. On the screen, you can see the top 10 asset management companies that are performing really well. You can see over here, you have the SBI mutual funds, you have the HDFC, ICICI Prudential, Birla Sun Life, Nippon, Kotak, Axis, UTI, IDFC, Franklin Templeton, and this list is basically not fixed. It keeps on changing, fluctuating on the basis of the performance of the various AMCs. So, basically this is just on the screen, you can just see the example of the AMC, the asset management company, that is one of the constituent of the mutual fund, right. They are the people, they are the experts who are basically managing the mutual funds to get the best performance in the form of high returns and low risk. So, with this I conclude my lecture of mutual funds. So, mutual funds is an avenue, it is the avenue that is gaining high momentum in today's investment options. As I also said and in the beginning of my lecture, in which I said that as the purchasing power of the people is increasing, as the savings is increasing, as the knowledge and awareness is increasing, people are taking more and more of interest to gain from the returns of the stock market. So, with this I conclude my lecture on mutual fund. Thank you everyone.